What if I told you that the very thing keeping you awake at night, debt, is precisely what the wealthy use to build their fortunes? While most Americans struggle with debt, viewing it as a burden to be eliminated, the ultra-wealthy deliberately seek it out as a sophisticated tool for exponential growth and wealth preservation. In the next few minutes, I'll reveal the 6 debt strategies that separate the wealthy from everyone else. Principles practiced religiously by billionaires worldwide, but rarely taught in schools or universities. These are the financial secrets that create generational wealth and allow the rich to play by an entirely different set of rules. The Empire Builder's Secret. In 1859, a 20-year-old bookkeeper named John D. Rockefeller borrowed $1,000 from his father, equivalent to about $35,000 today, to start a modest agricultural commodity business. At a time when most people feared debt and lived within limited means, Rockefeller recognized something revolutionary about leverage. This single act of calculated borrowing became the cornerstone of Standard Oil, a company so valuable that at its peak, Rockefeller's wealth would be worth approximately $400 billion today, more than Bezos, Gates, and Musk combined. His story represents perhaps the greatest example of how strategic debt can transform a small investment into an empire that changes the course of economic history. What made Rockefeller exceptional wasn't merely his willingness to take on debt, it was his strategic deployment of it. When kerosene demand soared, he borrowed aggressively to scale production, while simultaneously slashing costs by producing barrels in-house. His impeccable credit history gave him access to capital at rates his competitors couldn't match. With each loan repaid on schedule, bankers became increasingly eager to fund his expansion. In Rockefeller's hands, debt wasn't a burden, it was a precision instrument for market domination. Living rich without income. Consider this perplexing reality. Elon Musk, one of the world's wealthiest individuals, earned $0 in salary from Tesla for years. Yet he maintains a lifestyle most can only dream of: private jets, multiple mansions, and the ability to fund ambitious ventures with a single decision. Musk revealed the mechanics behind this apparent contradiction in a 2021 tweet. "I only have stock, thus the only way for me to pay taxes personally is to sell stock." This brief statement, overlooked by most casual observers, contains a financial revelation worth millions to those who understand its implications. This statement unlocks a wealth preservation technique. The wealthy don't live off salaries, they live off strategic borrowing. Instead of selling assets and triggering capital gains taxes, the ultra-rich use those assets as collateral for low-interest loans. The borrowed funds, which are not considered income by the IRS, finance their lifestyles while their assets continue appreciating. This creates what wealth managers call a buy, borrow, die strategy. The wealthy buy appreciating assets, borrow against them for living expenses, and hold them until death, when heirs receive a stepped-up basis, effectively erasing capital gains tax liability. If Musk borrows at 4% against Tesla stock that historically appreciates at 20% plus annually, he's essentially being paid to borrow. When the loan term ends, he simply refinances against the now higher collateral value, creating a perpetual tax-advantaged cash flow. The real estate multiplier. The wealthy have mastered what financial strategists call the depreciation paradox, a sophisticated application of accounting principles that allows them to show paper losses to the IRS while simultaneously generating substantial positive cash flow into their bank accounts. This seemingly contradictory achievement represents one of the most powerful tax advantages available to strategic investors. Consider this example. An investor purchases a $1 million commercial property using 80% bank financing, $800,000, and $200,000 from investors. Annual debt service costs $100,000, and property maintenance runs $20,000, creating a total expense of $120,000. By securing tenants who pay $140,000 annually, the property generates $20,000 in positive cash flow. Here's where the strategy diverges from conventional thinking. The IRS allows building owners to claim depreciation, a non-cash expense. Using the standard 1/39th depreciation rate for commercial properties, the investor can claim approximately $25,641 in annual depreciation. This phantom expense transforms a $20,000 profit into a $5,641 tax loss on paper, meaning no income taxes are owed despite pocketing $20,000 in real cash. Even Elon Musk borrowed $61 million to acquire 5 properties in California, not because he lacked cash, but because strategic financing preserves capital for higher return opportunities while maximizing tax advantages. The corporate shield. When Elon Musk orchestrated his acquisition of Twitter for $44 billion in 2022, financial analysts noted a curious decision. He financed $13 billion with debt, despite having personal assets that could have covered the entire purchase without borrowing a single dollar. Far from being an oversight, this calculated choice exemplifies the sophisticated corporate structuring that separates elite wealth builders from average high-net-worth individuals. The transaction was structured as a leveraged buyout, LBO, where the acquired company's assets, not the buyer's personal wealth, secure the debt. This creates a crucial firewall between personal and corporate liabilities. If Twitter thrives, Musk captures the upside beyond debt costs. If it fails, lenders' recourse is limited to Twitter's assets. Musk's Tesla shares and personal wealth remain protected. This compartmentalization of risk represents the antithesis of how most people structure their finances, where personal guarantees place their entire net worth at risk for business ventures. The wealthy understand that corporate debt, properly structured, creates a one-way option: unlimited upside potential with strictly limited downside exposure. The liquidity strategy. In 2023, Mukesh Ambani, the titan behind Reliance Industries and one of Asia's wealthiest business leaders, secured a staggering $5.5 billion loan to finance a nationwide 5G network rollout across India, despite having a personal net worth exceeding $82 billion. The loan represented less than 7% of his personal wealth, an amount he could have liquidated without significantly impacting his financial position. Yet, he chose debt, a decision that reveals much about how the ultra-wealthy approach capital allocation. Why would someone with such immense resources borrow rather than self-fund? The answer: preserving asset portfolios while creating strategic liquidity. The wealthy recognize that converting valuable assets to cash often triggers tax events, disrupts compounding, and can signal a lack of confidence to the market. Instead, they leverage debt to create liquidity precisely when transformative opportunities arise. By borrowing at institutional rates, Ambani maintains ownership in appreciating assets while deploying capital into new growth vectors. The 5G investment is projected to contribute nearly $180 billion to India's economy by 2030, potentially generating returns far exceeding borrowing costs. More importantly, this strategy allows Ambani to preserve his existing asset portfolio for eventual transfer to his children, while still capitalizing on significant growth opportunities. The inflation arbitrage. In 2012, when Mark Zuckerberg was already worth billions from Facebook's success, he made a decision that puzzled many financial observers. He secured a home mortgage for his personal residence. Even more intriguing was the interest rate, just 1.05%, at a time when the average American homebuyer was paying around 2.76% for similar loans. This remarkable differential illuminates another sophisticated principle employed by the financial elite. The wealthy strategically use their exceptional creditworthiness to secure preferential terms, then deliberately use inflation as a silent partner to systematically erode the real value of their debt over time. By securing a 30-year fixed-rate mortgage, Zuckerberg effectively locked in repayment with dollars that become progressively less valuable as inflation continues. If inflation averages 3% annually, the real value of his loan will diminish by approximately 60% over the mortgage term. Simultaneously, Zuckerberg deploys his capital into higher-yielding investments. If his portfolio generates even modest 8% annual returns, the spread between borrowing cost and investment return creates substantial wealth over time. The intelligent investor's approach to debt. After examining these 6 sophisticated debt strategies employed by some of the world's most successful wealth builders, we can distill several fundamental principles that you can begin applying to your own financial life, regardless of your current net worth. 1. Debt is a tool, not a burden, when used to acquire appreciating assets rather than depreciating consumer goods. 2. Strategic borrowing creates tax advantages that can accelerate wealth accumulation when properly structured. 3. Separating personal and business liabilities through proper corporate structures protects assets while maintaining growth potential. 4. Your creditworthiness is a valuable asset that can create preferential borrowing terms and significant financial advantages. 5. Inflation becomes your ally, not your enemy, when you're a long-term debtor repaying with ever cheaper dollars. The wealthy have long understood what most financial education fails to teach. Debt, when properly structured and strategically deployed, isn't something to fear or eliminate from your life. It's actually one of the most powerful levers available that can multiply your financial impact far beyond your personal resources. The question now becomes, will you continue to follow conventional wisdom about debt that keeps most people trapped in the middle class? Or will you begin applying these sophisticated principles to strategically build your own financial empire? The choice, as always, is yours. But now you possess knowledge that few ever discover. Before you go, if you found value in these wealth-building strategies, simply comment "valuable" below and let me know which principle you're planning to implement. Also, do not forget to watch our previous video about the millionaire's secret, how the rich use debt to create infinite wealth, which delivers you kinds of wealth strategies that aren't taught in traditional education. I'll see you in the next video.